Welcome to the daily stock Beaver market briefing. Today is August 21, 2026, and we're going to dive straight into the market snapshot. The Dow climbed 0.98% to 53,277, but all three major indexes still finished the week lower. America's national debt crossed $40 trillion, and Washington answered by doubling buybacks of long-dated government bonds. Gold rose 2.39% to $4,680 an ounce, and Bitcoin jumped 6.27% to $77,588, capping a 23% weekly gain, its best since 2023. This week's story wasn't earnings, and it wasn't stocks, it was the bond market, and whether Washington can keep it calm. Three stories drove it. First, the debt. With the total past $40 trillion, Treasury Secretary Scott Bessent moved to double buybacks of long-dated bonds, aimed at the 30-year yield, which sits at 5.19%, near multi-year highs. The relief was fleeting. Long-term treasuries still fell 0.35% today, and Schwab's Cooper Howard called the liquidity boost a relative band-aid. Second, the Fed is leaning the other way. Minutes from the July meeting showed support growing for a rate hike, and Chairman Kevin Warsh speaks at Jackson Hole next week, with July's inflation data arriving alongside. Third, the consequences. The dollar slid to 98.75 on the index, and money rotated into hard assets. That's our commodities story just ahead. Gold up 5.48% this week, silver 6.79%. And later in the show, our Fed and credit analysis asks the question underneath it all. Can a Treasury put replace a Fed put? Meantime, the earnings came from retail and the farm. Target earned $4.11 a share in its second quarter, roughly double last year's, though $1.65 of that came from $994 million in tariff refunds. Sales grew 5.3% on customer traffic alone, and the company raised its full-year outlook. Analysts lifted their price targets Friday. TJX posted adjusted earnings of $1.22, up 11%, on a 4% comp, and raised its profit outlook too, while rival Ross Stores jumped 8% to $246.60 on reported 10% comps. And Deere lifted its net income outlook to as much as $5 billion, calling 2026 the bottom of the ag cycle, with construction order books booked 4 to 5 months out. Step back and the pattern is unmistakable. Stocks rebounded, but the real money moved out of bonds and dollars and into gold, silver, oil, and Bitcoin. That's not greed. That's hedging, a market bracing for fiscal trouble rather than chasing growth. Now the dashboard. The S&P 500 rose 0.43%, the nasdaq rose 0.43%, the Dow gained 0.98%, and the Russell 2000 climbed 0.85%. Though every one of them lost ground for the week. The VIX Fear Index sits at 15.13, calm on the surface, and our overall regime reads neutral. Long-term treasuries fell 0.35%. The 10-year yield eased about 6 basis points to 4.65%. The national debt stands at $40.3 trillion, up about $20.6 billion in a single day. We take a deep dive into the federal budget later in the show. Gold is at $4,680. Silver at $69.53, and we'll go much deeper on both next. Oil slipped 0.88% to $87.6, but gained 5.66% this week. Bitcoin sits near $77,588, up 6.27%. 14 groups on the board, 10 green, 4 red, and the split tells the rotation story. Materials led, up 2.16%, the clearest expression of the hard asset trade. Miners and chemicals ride the same inflation worry and dollar weakness that carried gold up 2.39% today. Software gained 1.43% and healthcare 1.24%, a sign the rally broadened beyond the megacaps. Technology itself was nearly flat at 0.5%. The laggards are the tell. Semiconductors fell 0.44% against a rising market. Memory chip price inflation is starting to squeeze the buyers of chips, not just enrich the makers. And utilities dropped 2.26%, the worst group by far. Rate-sensitive bond proxies have few friends with the 30-year yield near 5.19%. Financials gained 1.2% as bank strength powered the Dow's outperformance. Hard assets and banks up, rate-sensitive and chip-adjacent names down. That's today's market in one picture, and it leads us straight to its shiniest corner, precious metals next. Weekend review. The trading week ran August 14th through the 21st, and here's the headline. The market's problem wasn't that it fell, it was where it fell. The S&P 500 lost 1.43% and the nasdaq dropped more than 2%, while the Dow held up best, down less than 1%. On the surface, a routine August pullback, and the year-to-date columns confirm nothing is broken. The Russell 2000 is still up more than 20%, the best of the majors, even after giving back ground this week. But the composition of the selling was the tell. Semiconductors, up nearly 66% year-to-date coming into the week, fell 5.52%, the worst group on the board. That's the year's winner taking the hit, while technology, utilities, and industrials all dropped around 3.5%. And industrials fell even after Deere raised its full-year profit outlook midweek. When good news from a bellwether can't lift a sector, the market is trading something bigger than earnings. It was trading Washington. The national debt crossed $40 trillion, Treasury Secretary Scott Bessent moved to double buybacks of long-dated bonds, and the 30-year yield sat near 5.19% anyway. That anyway is the story. When official support can't move the long end, money rotates. 4 sector groups rose, 10 fell. Healthcare led at 4.13%, a defensive laggard catching up, which is a classic caution signal. Energy added 2.81%, extending a nearly 40% year-to-date run as oil logged a second straight weekly gain, and materials tacked on almost 2% as the real asset bid spread. That's the rotation in one sentence. Out of long-duration growth and bond proxies, into real assets and defensives. The trade you make when you're worried about a government's balance sheet, not when you're chasing profits. The cross-asset board delivers the verdict, and the verdict is, this wasn't risk-off. Stocks dipped, but gold rose 5.48% this week and silver 6.79%. Crude gained more than 5%, and Bitcoin surged 23.48%, its best week since 2023. The dollar index slipped 0.69% underneath it all. Now here's the part the weekly bars hide. Bitcoin, despite that monster week, is still down 12.57% year-to-date, and silver remains off nearly 5% on the year. These aren't euphoric markets at their peaks. They're bruised assets rebounding on a wave of hedging. Long-term treasuries were the fulcrum, flat on the week at 0.3% after the buyback announcement, but still down more than 5% year-to-date. So when stocks fall modestly while gold, silver, oil, and Bitcoin all rally together against a weakening dollar, that's not risk-off and it's not risk-on. It's a market buying things nobody in Washington can print more of. So here's the week in one line. A rotation, not a rout. The year's AI-led gains paused while capital repositioned for fiscal risk. Whether that repositioning continues depends on 2 events next week. Fed Chairman Kevin Warsh's speech at the Jackson Hole Symposium and July's inflation data. Which brings us to the commodities board, starting with energy, where the year's biggest gains are concentrated. Commodities. The commodities story of 2026 is a story about trust, and the leaderboard proves it. Heating oil futures are up 106.1% year-to-date, more than doubling. Wholesale gasoline is up 78.3%. And wheat, the one thing on this board you eat rather than burn, is up 50%. The pattern matters more than any single bar. The things households physically burn and eat are the year's best-performing assets, which is what happens when investors want to own things governments can't create more of. And this week added another chapter, gold up another 5.2%, crude up more than 5%, with the positioning behind both moves more stretched than prices alone suggest. Energy first, and the driver here is geopolitics, not demand. WTI crude sits at $86.78 a barrel, down 1.2% today, but up 5.3% this week, a second straight weekly gain with Brent at $94. Why the resilience? Iran. CNBC reports Washington vowing its toughest sanctions ever, and Reuters says offers of Iranian crude to Chinese buyers are already drying up as the blockade bites markets, in one analyst's words, pricing the failure of diplomacy. Ukrainian strikes on Russian refineries round out the supply risk. The exception is wholesale gasoline futures, down 7.2% today, after the EPA allowed an earlier switch to cheaper winter blend fuel, potentially 10 to 30 cents a gallon off pump prices eventually. Though remember, retail lags futures and moves less. The EIA's inventory report for the week of August 14th separates what's real from what's fear, and it says fear is doing the work. Crude stockpiles drew 5.3 million barrels, a bullish headline. But look at the other side of the refinery. Gasoline supplies still built 0.7 million barrels, even as refineries pushed runs to 17.4 million barrels a day. Gasoline building while refining accelerates is a demand warning from the pump. Natural gas storage, meanwhile, sits comfortable near 3170 billion cubic feet heading into autumn. Translation: today's oil premium is fear of disrupted supply, not a shortage in the tanks, which also explains why gasoline futures, not crude, are the ones breaking on the policy news. The smart money readings split down the complex, and the split is the insight. Big traders, that's the hedge funds and CTAs, are 25.7% long wholesale gasoline, the 95th percentile of the past 6 years. Crowded means fragile. One policy reversal and everyone exits at once. And note the EPA just handed gasoline exactly that kind of reversal. Crude itself is the opposite story. Producers are short only 14.5% of contracts, the 6th percentile, near the lightest hedging in 6 years. When the companies that pump the oil decline to lock in prices above $85, they're voting the rally holds. And in natural gas, traders sit 21% short at the 91st percentile while banks stand net long. Textbook squeeze fuel if winter power demand arrives. Is the precious metals bid fear or growth? The price action answers fear. Gold is at $4,700 an ounce, up 5.2% this week and more than 12% in the past month. Silver is $69, up 6% this week. Platinum's up more than 7%. Yet copper, the metal you buy when you believe the economy's accelerating, is slightly down on the week. That precious up, industrial flat split is a haven trade, full stop. And Ray Dalio gave it its voice on Friday, telling CNBC the Treasury's buyback move is a sign a debt crisis is getting closer. His recommendation: gold and Bitcoin over bonds. The positioning behind that trade is lopsided, which tells you both who's driving it and what could stop it. Managed money, the hedge funds, are 28% long gold against just 2% short, the 91st percentile. Bearish bets are nearly extinct, which means there's little fresh fuel left in that crowd. Anyone who wanted gold has mostly already bought it. The rotation candidate is silver, where longs sit at only the 7th percentile, dramatically underowned, which is dry tinder if the haven trade broadens. Copper producers, meanwhile, are short 42.3% of contracts at the 70th percentile, the industry locking this rally in. And palladium carries our highest risk flag in metals. Traders are short 48.4% of all contracts while banks stand on the long side, a setup built for a violent snap upward. What unwinds gold's crowd? A hawkish Warsh at Jackson Hole or a soft inflation print? Now your grocery bill. Futures lead shelf prices by months and the direction is unwelcome. Wheat is up 50% this year, rice up almost as much, and sugar has surged 19% in the past month alone, the fastest mover on the board. Coffee, down 9% on the year, and orange juice, down 23%, offer rare relief, and beef is cheaper as Washington widened imports after drought shrank the herd. Expect gradual, muted pressure on pantry prices rather than overnight shocks, processors hedge, and grocers absorb part of the move before it reaches you. Behind the food rally, our positioning data caught a genuine momentum flood. Big traders added more than 92,000 sugar contracts in a single week, with corn and soybeans pulling in tens of thousands more apiece. That matters because hot money exits the way it entered. A dollar rebound would unwind all three at once. The offset: soybean producers are short more than half of all contracts, at the 73rd percentile, the industry selling into the crowd, which tells you farmers see these prices as worth taking. Which brings us to that dollar. Currencies. The dollar's problem this month isn't the Federal Reserve, it's arithmetic. Traders describe a rotation away from the dollar and into currencies of economies with better fiscal discipline and lower debt, and the past month shows it. The dollar has lost roughly 2.5% against the euro, the yen, the Aussie, and the Canadian dollar in 30 days. And notice the divergence the yearly column hides. The dollar index is still up 0.54% year-to-date, but since debt crossed $40 trillion, the direction has been one way. That gap between the annual number and the monthly trend is the fiscal confidence trade happening in real time. The euro is testing 1.17, eyeing a fourth straight weekly gain. The Aussie is the year's standout major, up 7% against the dollar, riding the same commodity wave we just walked through. And the yen is strengthening even with oil rising. The dollar buys about 159 yen, sliding towards support near 158. In emerging markets, two outliers tell opposite stories. The Turkish lira has lost 11.7% of its value against the dollar this year. That's chronic inflation, not news, a slow-motion story. The Korean won has been among the sharpest movers anywhere, gaining more than 6% against the dollar in the past month alone. That's fast money, and likely the same repositioning. The Mexican peso and Brazilian real, both up roughly 6% on the year, are riding the weak dollar, strong commodity wave. When raw materials rally, their export economies collect the windfall. Here's the twist our internal analysis flags. The crowd was positioned for the opposite of what just happened. Big traders are still 31.7% long the dollar index, with bearish bets near their smallest in 6 years, meaning the crowd was set up for dollar strength just as the dollar slid. They're on the wrong side, and unwinding those positions feeds the move. That's how trends accelerate. The mirror image is the euro, where trader shorts sit at the 98th percentile, more crowded than almost any point in 6 years of data, even as the euro rallies. That's forced covering, not conviction. And yen shorts at the 77th percentile are a moderate risk squeeze candidate if Tokyo intervenes near 158. For your wallet, a dollar weaker than it was a month ago means that trip to Europe or Australia just got more expensive, not less, while U.S. exporters and anyone holding international funds catch a small tailwind. The bottom line, the dollar has become the market's fiscal confidence gauge, and Jackson Hole is the test. Treasury and Rates. Here's the yield curve, and it's telling a story every saver should understand. The 30-year bond pays 5.19%. The shortest bills pay under 4%. Investors demand nearly 1.5 extra percentage points to hold the country's longest IOUs instead of its shortest, and the 10-year minus 2-year spread at plus 0.46 makes the same point mid-curve. Normally, a curve this steep signals growth expectations. This one is different. It's a fiscal risk premium. The debt just crossed $40 trillion, and Treasury is now buying back its own long bonds to suppress borrowing costs. The long end did ease modestly this week after the buyback announcement, a few hundredths of a point, but Schwab's Cooper Howard called the liquidity boost a relative band-aid, and the 30-year remains near multi-year highs. For real people, short-term treasuries near 4% mean money markets and CDs finally pay meaningful income on the safe part of a nest egg, while a 5.19% long bond keeps mortgages and car loans expensive. Cash pays again, credit costs. Underneath, the plumbing is strained. Treasury trading is running about $1.2 trillion a day, elevated, but here's the number that matters. 53% of it is dealers trading with each other rather than with customers. That churn is a balance sheet strained signature, banks passing risk around because nobody wants to warehouse it, which is exactly the condition that makes markets jump when volume spikes. The smart money is short this market massively but selectively, and the selectivity is the story. Big traders hold shorts equal to 37.8% of all 10-year contracts, the 86th percentile, with the 5-year similar. Yet the 30-year shorts are actually light, the 13th percentile, and 2-year shorts just covered more than 100,000 contracts. Read the structure. This isn't a bet against America, it's a bet the middle of the curve suffers most, the part most sensitive to a Fed that can't rescue the long end. Pension funds hold the other side, half of all 10-year contracts, while bank shorts sit at the 95th to 99th percentiles, near 6-year extremes. If Treasury's buyback actually works, this crowd squeezes violently. In stocks, the caution is real but not extreme. The danger is concentrated in one corner. Leveraged funds are net short the S&P by about 260,000 contracts, and our risk flag there is low. Meaningful caution, not panic. VIX longs, the crash protection trade, are elevated, though only at moderate risk. Bitcoin is the outlier, and it just showed everyone what a crowded short does. Traders were short 54.5% of all Bitcoin futures, our highest risk flag, and the price ripped 24% to a peak near $79.5 thousand, forcing billions in liquidations. That's the lesson for the rest of this board. When positioning gets that one-sided, the next move goes the painful way. Step back and every crowded position leans the same way. Short duration, short the euro, short the yen, long gold, long gasoline, one coordinated bet against Washington's fiscal management, with the dollar longs wrong-footed and unwinding. Our stock Beaver positioning analysis as of August 18th flags 2 high-risk situations. Palladium, with 48.4% of contracts sold short, and Bitcoin at 54.5%, both prone to violent snapbacks, so treat any exposure there as glass, not steel. Gold's 91st percentile long is stretched too. If you've ridden this run, banking some gains is just discipline. The big money is positioned for fiscal dominance. The danger is that everyone is positioned the same way. Now that we've seen where rates stand, let's pull back for the bigger economic picture, the Fed, the jobs market, and what Jackson Hole might deliver. Economy and the Fed. Here's the bigger picture, and we always start with the map, the recession clock. Our composite of leading indicators still reads expansion, with an imminent score of 22.3 out of 100. That's a low number, and the level is the message. Nothing is flashing, not even close. The SOM rule, the early warning jobs trigger, sits at 0.10 against a 0.50 tripwire, meaning the labor market would have to deteriorate 5 times over before that alarm fired. And the yield curve has snapped back to a normal steep plus 0.82, the shape markets draw when they're pricing growth, not contraction. Even the freshest labor red first-time claims at 206,000 says layoffs aren't the story. Remember the sequencing here. GDP and payroll headlines only confirm this clock. They lag by months. The clock is the forecast. So what actually moved this week, and what's the thesis? The scoreboard tilts tighter. 10-year inflation expectations. The break-even rate jumped a tenth of a point to 2.34%. That was the single biggest move on our economic board, and it matters most because expectations are the one variable a central bank can't look through. Housing starts plunged 12.4% in July. When builders pull back that hard, it's a forward bet on weaker demand. And retail sales fell 0.6% against forecasts of a small gain, our growth engine missing to the downside. Read together. Growth is cooling at the edges while inflation expectations wake up. That mix doesn't threaten the expansion, it threatens the Fed's patience. The inflation dashboard shows why that break-even move matters, because the stirring is in the forward-looking measures, not the rear view. July's consumer price index had prices up 3.4% from a year ago, core up 2.5%, both exactly on expectations. That's the telling part. The prints themselves are calm. But the University of Michigan's August survey found households expecting 4.3% inflation next year, more than double the Fed's target, and once expectations move, they tend to feed themselves into wages and prices. Meanwhile, the real yield, what Treasuries pay above inflation, holds at 2.35%. Some history. Before 2021, real rates spent a decade below zero. Today's level is genuinely restrictive, and that's exactly why gold and rate-sensitive assets fight headwinds even while inflation cools. Inflation isn't accelerating in the data, expectations are stirring around it. And the Fed's preferred gauge, core PCE, lands next week, right alongside Jackson Hole. If inflation expectations ran warm, housing delivered the cold front. July housing starts fell 12.4% to 1.24 million units, far below the 1.35 million economists expected. But here's the tell. Building permits rose 5% to 1.44 million, beating forecasts. Builders are pausing shovels, not plans. Starts measure what they're doing today, permits what they intend to do next, and permits are the leg the recession clock actually watches. Pending home sales slipped too. Owners locked into cheap mortgages aren't budging. With the 30-year mortgage near 6.7% and construction employment still growing, this looks like rate-bound frustration, not a demand collapse. The buyers are there. The financing math isn't. Here's the cleanest lens on the week's rates story, and it's worth committing to memory. A Treasury yield is two things stacked: the inflation investors expect, plus the real return they demand on top. On the 5-year, that's 2.34% expected inflation plus a 2.5% real yield, roughly 4.4 all in. The level matters less than the split, and this week the split flipped. The break-even leg rose a tenth while the real yield leg eased. Why care about the split? A real yield-led rise is the market demanding more return. The Fed can wait that out. An expectations-led rise is the market bracing for inflation, the one move a central bank can't look through. That's the context for those July Fed minutes showing support building for a hike. And a note for gold holders. An easing real yield cuts gold's opportunity cost. A tailwind and gold's 5+% week fits exactly. Zoom out to the whole curve. The 10-year ended Wednesday at 4.69%, drifting higher on the week, the direction the expectation story predicted. The 10-year minus 2-year spread sits at plus 0.50 and steepening. The same normal regimes signal the clock flagged, and steepening means the market is pricing growth or easier policy ahead, not recession. For your wallet, the Fed funds rate holds at 3.63%, roughly what money market funds and savings accounts pay, while the prime rate at 6.75 keeps credit cards and home equity lines expensive. It's the gap between what your cash earns and what your debt costs that you actually feel. On the Fed's balance sheet, quantitative tightening is quietly fading out, and the fade is the story. Total assets stand at $6.75 trillion, but up 0.6% over the past year. That positive yearly number is the tell that runoff has slowed to a crawl. The plumbing matters more. The reverse repo sponge is essentially empty, at $0.2 billion. That pool used to absorb the Treasury's spare cash. With it drained, every further dollar of shrinkage now comes straight out of bank reserves, which slipped to $2.94 trillion, and reserves are exactly where funding stress historically shows up first. Meantime, the mortgage book keeps rolling off. One quiet reason that 6.7% home loan won't budge. The fear gauges show calm, with one crack. The VIX closed Wednesday at 16.1 normal territory. The crack is composition. NASDAQ volatility at 23.26 runs 7 points above the S&Ps. The nerves aren't broad. They're concentrated in tech, which tells you where the leverage and the expectations live. And the economic policy uncertainty index spiked to about 302, up more than 160 points in a single day. That's a policy shock, not a market shock. Washington's bond market activism rattling the policy gauge while stock fear stayed muted. When uncertainty moves and volatility doesn't, the risk hasn't been priced yet. Underneath it all sits the consumer, bent, not broken. Inflation-adjusted retail sales are up 1.7% from a year ago, spending still growing after you strip out price increases, which is the only growth that counts. But the July monthly print fell 0.6% against an expected small gain, the biggest consumer surprise of the week, and the direction matters more than the size. Momentum turned. Michigan sentiment slid to 51 from 55. Sentiment this low with spending still positive is the vibe gap. Households swiping the card while telling survey takers they're miserable. Worth watching, not yet worrying. The June trade report out this week showed the goods and services deficit narrowing to $73.3 billion, roughly 6% smaller than May. Don't celebrate the monthly improvement. It's mostly the tariff front-running spike still compressing. The real story is the year-over-year picture. The deficit is still nearly 25% wider than a year ago. That's strong dollar arithmetic. A strong dollar makes imports cheap and exports pricey, and the trade account keeps the score. The goods-only gap of $101.5 billion came in wider than the $100.3 billion expected. A reminder that import demand hasn't cracked even with growth cooling at the edges. Investor leverage is the quiet risk in the background. FINRA margin debt stood at $1.42 trillion in July, up a striking 38.6% year-over-year. Circle that one. Expansions above the 30% zone have historically flagged late-cycle exuberance, the point where borrowed money, not conviction, is driving prices. But July itself saw a 5.65% monthly decline, the crowd trimming for the first time in a while, and the net credit balance of minus $995 billion says investors collectively borrowed well past their cash cushions. High leverage just beginning to unwind doesn't call the top, but it tells you how steep any unwind could get. Pair it with a VIX at 16, maximum leverage meeting minimum fear, and that's the classic late-cycle portrait. One transmission channel to close on: oil and yields. This gauge tracks how tightly crude and the 5-year yield move together over a rolling 90 days. Above roughly 20%, oil is a live driver of rates rather than background noise. Which channel is carrying the move? Check the decomposition, not the textbook. The textbook says an oil spike lifts inflation expectations, which lifts yields, but that's only true when the break-even line is actually rising. This week it did, so oil is indeed pushing through the expectations channel. The 2022-style coupling, the one route the Fed cannot shrug off. With crude rallying on Middle East supply risk, that linkage is one more reason Jackson Hole carries real stakes. An oil shock that lands in expectations forces a response. One that lands in real yields, the Fed can wait out. So the verdict. This week reinforces the expansion clock no recession signal, while nudging the inflation floor higher. Growth cooled at the edges, expectations warmed, and the Fed sits squarely between them, with Jackson Hole and core PCE landing next week. And the companies closest to that consumer had plenty to say. The earnings pulse is next. Earnings pulse. 3 sectors made the cut this week, and here's the scoreboard at a glance. Technology, the heaviest reporting slate with 11 calls in the past 2 weeks, went 6 for 6 on earnings beats. 4 of those 6 raised guidance, and the tone is uniformly bullish. Industrials, the market's worst weekly performer at minus 3.68%, still managed 3 beats out of 4 with 3 raises, also leaning bullish. And consumer defensive, where safety money rotated in, went 2 for 2 with both names raising guidance. Let's break them down. The verdict on technology: pricing power is consolidating, not fragmenting, and it's consolidating at contractually protected choke points. In plain English, the companies that control scarce capacity or must-have technology are locking in prices with multi-year agreements, and everyone downstream is paying up. Consider the board. All 6 companies beat on earnings and revenue, 4 raised guidance, none cut, and yet the sector fell 3.38% this week, with most of these stocks down since their calls. That gap between what executives are saying and what investors will pay is the story. Start with analog devices, ticker ADI. CFO Puccio told investors the company just booked its first $4 billion quarter ever, $4.2 billion in revenue, up 40% year-over-year, and the price increases announced earlier this year haven't fully landed yet. In his words, the full extent of the price action isn't captured until next quarter's shipments. Cisco, ticker CSCO, called this the beginning of a super cycle, orders up 35%, with $4 billion of AI infrastructure orders in a single quarter. And about 5 points of that revenue growth came from price increases customers are accepting. Applied Materials, ticker AMAT, raised its chip equipment outlook for the 3rd time this year, crediting a value-based pricing program with roughly 300 basis points of gross margin gains over 3 years. And here's the twist. The strongest fundamentals got punished hardest. Keysight's CEO says demand is far exceeding the company's ability to supply record orders for a third straight quarter, and the stock is down about 12.5% since the call. The one name the market rewarded was Jack Henry, ticker JKHY, up 8.5% after a record 58 competitive wins in bank technology, with management saying they're taking share from everybody right now. Steady, share-taking businesses got paid this week. Even great cyclical ones didn't. The verdict in industrials. Pricing power is consolidating along 4 distinct moats: scarcity-backed infrastructure, aftermarket lock-in on installed equipment, route density with contractual escalators, and software franchises layered on top of machines. It's also a sector under real cost pressure, down 3.68% on the week, the worst of any group, with diesel at $3.86 a gallon at Union Pacific in the backdrop. The contrast here is Deere versus Rocket Lab. Deere, ticker DE, earned $5.10 a share against $4.69 expected on $12.6 billion of revenue, raised its full-year profit outlook to between $4.75 and $5 billion, and management is calling 2026 the bottom of the ag equipment cycle. Crucially, Deere held prices in all 3 segments and said it would rather underproduce than discount. Investors loved that discipline. The stock is up 11.5% since the call. Rocket Lab went the other way. A loss of 8 cents a share where a 6-cent loss was expected, the only earnings miss on this board, and the stock fell 12.4%. Yet listen to the CEO. He's personally never seen launch supply this constrained, pretty much ever. Revenue was a record $234 million, up 62%. That's not a demand problem. It's a profitability timing problem, and guidance remains unclear. In between, Nordson posted a record quarter, $818 million in sales, up 10%. With backlog up 35%, and raised guidance, though the growth is volume-led rather than price-led. And Ferguson, the plumbing and HVAC distributor, says big project demand is broadening beyond data centers into power generation and mining, and it raised its full-year outlook even as commodity deflation tests its pricing discipline. The verdict in consumer defensive. Pricing power will belong to whoever can defend a genuine moat, and this week showed 2 opposite ways to win. Both companies beat and both raised guidance, but their pricing stories could hardly be more different. Estée Lauder, ticker EL, delivered the biggest post-earnings move on our entire board, up about 21% since the call. Gross margin hit 75.5%, up 360 basis points, back near historical highs. The tell is China. Organic sales rose 9% with market share gain for 6 straight quarters, while the company pulled back on discounting. We are now less promotional, management said, pushing what they call valorization. That is pricing power in its purest form, realizing higher prices while still winning share. Target, ticker TGT, is running the strategy in reverse, deliberately. Earnings of $4.11 looked enormous against last year's $2.5, but $1.65 of that came from $994 million in tariff refunds. The underlying business is healthy, comparable sales up 3.8%, driven entirely by store traffic. Yet Target has cut prices on more than 10,000 items over the past year, with 95% of school supplies at or below last year's prices. Management still raised full-year guidance, and the stock added 8.5%. So the tone reads mixed. Volume is winning, but this is a retailer investing in price, not harvesting it. Same sector, same results, opposite philosophies, and both stocks went up. Now step back and look at the whole board. 11 of 12 companies beat their earnings estimates, 9 raised guidance, and not one cut it across tech, industrials, and consumer staples alike. Yet all 3 of these sectors still fell this week. The conference calls are describing expansion. The trading tape is pricing worry, mostly about rates and the bond market. Someone is wrong, and the coming weeks of data will tell us who. Now let's see how this lands on our top stock and ETF picks. Market technicals. Take the whole year in one view. Energy stocks, the XLE fund, lead everything, up 39.41%. And yes, the leader is also the most stretched. Energy trades 12.59% above its 50-day moving average. That's the trend line under the price, the biggest gap on the board. A winner that far ahead of its own trend is the likeliest spot to pause. Watch it, don't fear it. The rest is healthier than this week's headlines suggest. 80% of these funds sit above their trend lines, so breadth is real, not thin, and the typical speedometer reading, the RSI, a 0 to 100 momentum gauge, sits near 50, dead neutral. Small company funds are up more than 20%. The seller belongs to long-term Treasury bonds, ticker TLT, down 5.72%. On the risk mood, money is chasing a particular blend of calm and grit. The past 3 months leaders, healthcare XLV, which has beaten the market by nearly 15 points while barely moving with it, a beta of 0.33, beta simply meaning a fund's jumpiness. Then banks and insurers XLF, small caps, and the hard asset names led by energy. The laggards, utilities, long treasuries, down more than 25 points against the market over the past year, and the nasdaq. This is not classic hiding, because bond-type safety is being sold. It is money buying steady earners and real assets while stepping back from pricey growth. Energy is the one flagged as stretched, running hard, due for a breath. On sector temperature, healthcare and financials are the hot hands strong on their own and beating the market, the classic late-cycle combination of leading while stretched. Healthcare's speedometer reads 68, near the 70 line where fast becomes overheated. Left behind, utilities, still falling on every measure beaten down but showing no sign of turning yet, so that is not where early money is heading. The quiet rotation is in tech. The XLK fund is still up 27% this year, but its recent score has faded to barely positive. The money that made tech's year has moved on to healthcare and banks. Stretched and leading means you are late. Beaten down and still falling is not yet a bargain. On investing styles, a role reversal is underway. The favored corner, strong on its own and beating the market, belongs to deep value, the cheap unloved companies in the IWD fund, on top for 5 straight weeks, with small size and minimum volatility calm stocks close behind. The washed-out corner, weak and lagging, sold until the sellers look exhausted, is growth, ticker IWF, sitting alongside long bonds and utilities. Growth funds in the basement is a genuine turn from recent years, and there is a first hint of rotation. Innovation funds have climbed back into positive territory, early evidence the beaten-down styles are starting to stir. On the whole market's temperature, the gauge reads 74 out of 100 and extended reading. Translation: the market is running warm, not overheated, and that mostly agrees with the price line. The uptrend is real. It has simply earned a pause, and readings in this zone usually leave the trend room to keep working. This week's dip, the S&P down about 1.4%, has the feel of exactly that, a breather, not a breakdown. On the money itself, our own approximation built from weekly trading volume, nothing fancier, scores 75.7, squarely in accumulation territory. Big money is still flowing in, and it agrees with price. Investors bought this week's dip rather than selling into it. When volume backs the trend like that, pullbacks tend to be pauses, not reversals. That is the quiet vote of confidence underneath a nervous week. And the crowd's mood. The stock Beaver sentiment composite reads 64.4 greed territory, though cooler greed than a year ago when this gauge stood near 82, and the trend since has been falling. What pulls the reading highest is the VIX, the fear index, near 16. That calm is doing most of the work, with strong momentum close behind, while the speedometer pillar sits dead neutral at 48. So a greedy crowd resting on a very quiet market. Comfortable until it isn't. Here is the one thing a non-trader should watch this week: energy. It is the year's leader and the most stretched name on the board. If it takes its breather gracefully, this rally can broaden. If it stumbles hard, watch how quickly the crowd follows it out the door. Top stock picks. Time now for the part of the show many of you wait for, our top stock picks. And we start every pick segment the same way, with the buy signal radar, our mechanical scan for stocks trading in active bull trends. Tonight the radar is crowded. 46 names are flashing buy signals, and that kind of breadth against a calm tape. The Dow added almost 1% today, the S&P 500 and nasdaq about 0.4% each, tells you participation is broad, not narrow. The longest streak belongs to Copart, ticker CPRT, at 4 consecutive sessions. Just behind it at 3 days apiece, Moderna, SanDisk, Targa Resources, and Phillips 66. And here's the confluence worth writing down. Moderna and SanDisk aren't just on buy signals, they also rank among our strongest swing candidates. A mechanical buy signal plus top-tier performance in our rankings is what we call high confluence. Merck earns the same tag, 2 days on a buy signal and sitting on our momentum list. Estée Lauder just flipped positive 2 days ago at $96.15. And notice the energy cluster: Targa, Phillips 66, Marathon Petroleum, Valero, Devon, APA, Texas Pacific Land, and Halliburton. 8 energy names on one radar screen isn't stock picking luck, that's a sector moving together. That radar sets the table. Now, the names actually moving this week. The story of the past 5 days is a rotation into healthcare. 8 of the 10 stocks on our momentum list come from that sector. Merck, ticker MRK, leads the entire market this week, up 12.3% at $152.55, and up 77.2% over the past year. The catalyst: that stunning Moderna news is a Merck-partnered program, a Phase 3 cancer vaccine trial, and Merck owns the commercial muscle behind it, with analysts noting its pipeline is building a growth cushion ahead of Keytruda's 2028 patent expiration. Target, ticker TGT, at $165.42, is up 7.1% this week after a confirmed second quarter report Wednesday, earnings and revenue beats plus a raised outlook, and analysts lifted their price targets today. That squares with the earnings pulse, a beat and a raise, though the tone was mixed, because shoppers keep coming while Target cuts prices rather than raising them. IQVIA, ticker IQV, up 9.8% this week and 60.4% over 3 months. Its AI-enabled clinical decision support tool just won a 2026 AI Breakthrough Award, and the trend is accelerating. Thermo Fisher, up 7%, just showed up in filings with Bank of New York Mellon building a new $1.97 billion stake. Abbott, ticker ABT, gained 4.8% after agreeing Thursday to a $670 million settlement resolving infant formula claims from about 2,000 people, clearing a legal overhang. And circle August 26 on your calendar. Agilent, ticker A, up 7% this week, has a company-confirmed earnings report that day. From hot money to recovery stories. Moderna, ticker mRNA, at $145.13, sits on a 3-day buy signal after what Benzinga calls its best day ever as a public company. That cancer vaccine readout partnered with Merck. The mRNA trade has whipsawed for 3 straight sessions, rallying 8% Friday on no fresh clinical news, which tells you the market is still repricing a single trial result. Marvell Technology, ticker MRVL, at $237.4, just handed Alphabet a warrant tied to more than $12.2 billion in potential chip purchases, and the stock sank 6% Thursday as investors digested the dilution. Choppy action, but a 207.1% gain over 6 months is a powerful trend underneath it. Tesla, ticker TSLA, triggered a fresh buy signal at $362.86, up 6% this week. Plans for a $16.8 billion chip factory with SpaceX are grabbing attention, though a recall of 3 million vehicles in China today is a reminder of the noise around this name. And Halliburton, ticker HAL, at $35.34, quietly added 3 energy technology companies to its portfolio this week, covering batteries, gas separation, and critical metals. It's up 6% since its last earnings report. Now zoom out to the big picture winners. Over 6 months, the leadership is unmistakable. The memory chip complex, SanDisk, ticker SNDK, just shy of $1,600 a share, up 479.9% this year and more than 3,400% over the past year. The driver is concrete. NAND memory prices have surged, and long-term customer contracts already cover a large share of expected volume. Micron, ticker MU, at $966.78, up 206.5% year-to-date. Analyst Dan Ives calls memory their world, and everyone else is paying rent, with demand still outpacing supply, though the stock slipped Friday as Wall Street debated its trillion-dollar valuation. Technology's earnings season just went 6 for 6 on beats, with 4 companies raising guidance, and that sector red, pricing power consolidating at contractually protected choke points, describes memory chips exactly. 2 cautions for the nasdaq crowd. Chip stocks wobbled this week on a 19-year high in the 30-year Treasury yield, not on chip news, and Michael Burry is warning the AI build-out echoes 2008-style excess. Away from semiconductors, Charles River Laboratories, ticker CRL, at $295.19, is up 35% in a month and 91% over the past year as bookings climb, and its drug safety business returns to organic growth. Plus a new vaccine development collaboration announced Wednesday. Target gets the Confluence callout. Hot this week, and up 64.6% year-to-date. And FactSet, ticker FDS, up 57.8% over 6 months on repeated earnings beats and expanding cash flow, just joined the buy signal board. Before we move on, a smart money side note. We overlaid our pick list with the latest FINRA short interest data, month-over-month changes in short positions and days to cover. The read across our names is quiet. No extreme builds, no dramatic covers. In plain English, the bears are not leaning against these moves. The rallies we've highlighted are being carried by genuine buyers rather than squeezed shorts, and that's usually the healthier kind of uptrend. Trends pushed by real demand tend to wear better than ones propped up by forced buying. Keep Agilent's August 26 report on your radar as the next scheduled catalyst on our board. And as always with this segment, think of it as education, not advice. Top ETF picks. We begin on the ETF desk, where the buy signal radar is about as crowded as it gets. As of last night's close, 115 leveraged ETFs are flashing active buy signals. The longest streaks sit in two places. NRGU, the 3x leveraged big oil ETN, has held its buy signal 4 straight days, and it also ranks in our momentum screen. That kind of confluence is what we'd call high conviction. TBXU, a 2x biotech bull fund, matches that 4-day streak with the same momentum tag. And notice the cluster. OILU and WTIU, 2 more energy funds, are also at 4 days. Essentially the whole oil complex lit up at once. Now the fine print, and please take it seriously. Leveraged ETFs use derivatives to amplify returns and losses alike. They're short-term trading vehicles that decay if you hold them, so keep positions small and have an exit plan. These are not buy-and-hold investments for a retirement account, or for money you're counting on. Moving to what's hot this week, the theme is old economy money. FCXG, which tracks Freeport McMoran at 2x leverage, sits at $18.27, up 31.6% this week and 35.5% this month. That's the copper trade, powered by data center construction and grid build-out feeding straight into the AI boom. Right behind it, NUGT, the 2x gold miners fund, at $207.88, up 29.3% this week, 74% this month, and 120.2% over the past year. That's the safe haven bid we keep seeing in precious metals. And HOOG, the 2x Robinhood fund, at $31.95, up 25.3% this week and 79.9% over 3 months, though it's still down more than half over a full year. Real assets and speculative appetite are rising together, and that combination tells you money is moving down the risk curve. The year-to-date board adds nuance. Benzinga reported earlier this week that Micron is back above $1,000, keeping its leveraged counterparts in the spotlight, and MOL, the 2x Micron fund, is up 408.8% this year, nearly 3,000% over 12 months. But it's down 2.6% this week, and the near-term trend is cooling. Spectacular year, tired legs. NRGU is the sturdier story, $55.95, up 201.3% year-to-date and second on both the yearly and 6-month leaderboards, with that 4-day buy streak behind it. LABU, the 3x biotech fund, rounds it out at $317.20, up 101.4% this year, 354.7% over 1. That's sector rotation into biotech. TBXU and BIB are on buy signals too. And the technology earnings sweep we covered earlier, 6 for 6 on profits, quietly backs the memory chip and networking names underneath these funds. Now the recovery shelf, where the swings get violent. CRCG, the 2x Circle Fund, is this week's standout at $15.13, up 47.5% in 5 days and 65.9% this month, riding the stablecoin and payments theme. MVLL, the 2x Marvel Fund, at $30.75, tells a comeback story, up 80.9% over 6 months, then a brutal stretch that took it down more than 70% over 90 days, and now an 11.1% rebound this week as AI networking finds its footing again. And UECG, the uranium play at $5.40, up 25.8% this week and 62.2% this month after a year that cut it nearly in half. More than half, actually, at minus 59.2%. These are 2x single stock bets on turnarounds. When the reversal comes, it comes at double speed in both directions. Among the classic leveraged funds, ERX, the 2x Energy Bull at $107.43, is textbook, up 84.7% this year, with a MACD bullish crossover, a golden cross, and a price above its 200-day average. XOMX, the 2x ExxonMobil fund at $50.25, shows the same setup, up 67.7% this year. And for income-minded listeners, SCDL, a 2x dividend factor note at $61.65, is up 53.1% this year in what our screens call a strong, steady trend. Tempting, but remember, 2x leverage cuts both ways, and a steady dividend theme still loses twice as fast in a downturn. A quick look at smart money plumbing before we close. FINRA's short volume data from yesterday shows TSLI topping the leveraged ETF board at 98.9% of volume, with VBX, EFZ, and SUPL clustered at 98.6%. Don't panic at those numbers. Most short volume is intraday market maker plumbing. The signal lives at the extremes, and notably none of today's picks appear in that top tier. Also worth knowing, inverse funds naturally rank high here, and heavy shorting of a bear fund is effectively a bullish bet on whatever it tracks. And on our specific picks, hedger activity is broadly normal, no major shorting or short covering signal this week. The trends stand on their own. Treat them as education, not advice, and size accordingly. Options activity and setups. Now let's flip to the options market. First, what the broader tape is telling us about fear and dealer positioning. Then we'll bring that red down to the individual stocks on today's pick list. Quick primer so everyone's on the same page. Calls are bets that a stock goes up, puts are bets it goes down, or insurance against a drop. The put-call ratio compares the two. Above 1 means more downside bets than upside ones, and that's where we are. About 1.3 puts for every call across the big index funds, cautious, not panicked. The nervous corner is small caps. The Russell Fund IWM traded 1.37 puts per call. But look at the price of insurance itself. SPY's 25 delta skew, the cost gap between out-of-the-money put insurance and upside lottery tickets, is just 4.28 points, a low reading. Flow says cautious, pricing says calm. That mix usually means routine hedging rather than genuine fear. Now the hardest concept of the segment, the dealers. Market makers sell most of these options, and they hedge with the underlying stock. Gamma exposure tells you which way they're forced to trade. Positive gamma makes them shock absorbers. They buy dips and sell rallies, dampening everything. Negative gamma makes them amplifiers. They chase the move, and swings get supercharged. Today, all three panels are negative. On SPY, dealers are short about 92,000 gamma, and the fund at $765.72 sits below its gamma flip at $771.46, the level where the shock absorber switches off and the amplifier switches on. QQQ tells the same story, $713.44 below a $718.79 flip. And IWM is the most amplified of all, roughly 500,000 negative gamma, with the flip up at $306.71. 3 for 3. The machinery is set to magnify moves. One more lens. Implied volatility versus realized volatility. Implied is what options pricing going forward. Realized is how wild the market has actually been. When implied runs well above realized, traders are bracing for something. The three richest sectors are financials at 1.38 times realized, real estate at 1.35, and utilities at 1.33, the entire rate-sensitive complex, which fits a week defined by bond market whiplash. At the other extreme, semiconductors are the cheapest at 0.75 times, options priced as if the chip trade will be calmer than it has actually been. That's either complacency or a bet that the storm has passed. The unusual activity scanner, where confluence is today's story. Tesla, ticker TSLA, tops the board, about 35,600 contracts changed hands, calls outnumbered puts roughly 3 to 1, and the volume nearly matched all existing open interest, meaning fresh money, not routine rolls. Tesla also appears in today's swing picks, exactly the overlap we look for. Then Apple, ticker AAPL, calls running 3 to 1 over puts, and Apple shows up on both our Senate and House trading screens, triple confluence. And gold, via the fund GLD, with a put-call ratio of just 0.21, the options market piling into the same hard asset rotation that defined this week's headlines. Almost everything else on the board leans bullish too. For anyone running a covered call book, owning the stock and selling a call against it, collecting premium the way a landlord collects rent, a few names stand out. Marvell carries 78% implied volatility, and a call 15% out of the money pays roughly 4.4% of the stock price over a 35-day cycle. Oracle at 69% implied pays about 3.8%, Corning about 3.4%. Those are period yields, not annualized. The honest caveat, these are high beta names. The premium is rich because the stocks genuinely move that much, and a covered call caps your upside on exactly the rallies that would bail you out of a drawdown. The leveraged versions pay even more. The 3X Semiconductor Fund SOXL, a call 15% out of the money, collects about 9.4% of the fund price in a single cycle. Tesla's 2X Fund TSLL pays around 4.8%, and double-length crude about the same. But land this caveat once plainly. These are decaying underlyings by design. That premium is income on a position you'd only hold with an existing view on the move. It is not a reason to own one. Now let's bring that backdrop down to our picks specifically, where in today's stock list does options positioning also argue for higher prices. We ran 10 confluence tickers through the screen. One name made the cut via bullish positioning bias. 0 passed the strict gamma squeeze checklist. The scorecard shows only the picks where options activity leans bullish. Neutral and bearish names were dropped upstream so we don't waste your time. Each row carries a squeeze phase. Pre-fire is a coiled spring, mid-fire means the amplifier's on, late means the move is mature, long gamma means dealers are running a dampener. Today there's exactly one row, LabCorp, ticker LH, and its phase reads neutral mixed. Translation: this is a mild lean, not a coiled spring. An honest board beats an exciting one. Here's the framework because it matters more than any single name. A true gamma squeeze setup needs 4 things at once. The stock below its gamma flip so the amplifier is on. Gamma exposure actually negative. A call wall, the strike with the heaviest dealer call exposure which acts like a ceiling, sitting 3 to 15% overhead for runway. And a put wall, the heaviest put strike, which acts like a floor in the same zone. LabCorp fails that strict checklist. 3 checks pass, but the call wall sits at $340, barely 1.1% above the $336.34 share price. That's a trap, not a runway. Any rally runs straight into dealer hedging within a couple of points. So why is it here? The second bucket, bullish positioning bias. The upside score is 31 against 0 on the downside. Different reason, same direction, smaller conviction. Lay the price map over it. LabCorp at $336.34. The gamma flip sits at $356.60. Spot is below it, which is why dealers are in amplifier mode, chasing the trend rather than fighting it. But the nearest level that matters is that call wall at $340, barely a percent overhead, where dealer hedging would slow any rally. Below, the put wall at $320, about 5% down, is where dip buyers tend to show up, and it happens to sit right at max pain, the strike where the most option contracts expire worthless. Earnings aren't until October 27, 67 days out, so this structure has room to breathe. Inside the numbers on LabCorp, 1 card today, so let's go deep. First, net gamma, about negative $190,000 worth. That's the amplifier dealers must buy as the stock rises and sell as it falls, so every move gets an extra push. Second, the volatility gap, implied volatility at 22.1% versus 30-day realized of 25.3%. Options are priced at 0.87 times what the stock actually did. Premium is cheap relative to experience. Third, today's flow versus the standing book. The day's put-call ratio is 1.32, slightly put-heavy, but total open interest sits at 0.84, which leans bullish. Fresh trading is cautious, the accumulated book is not. And the subtler exposures, Vanna and Charm, the dealer rehedging driven by volatility shifts and time decay, are modest to negligible. This structure won't move on its own. It's range-bound, waiting for a catalyst. Remember, this whole segment is positioning context, not a trade idea. A pick list with a tailwind underneath it is simply a higher quality setup than one without. That's the only claim. And with Apple already popping up on both congressional screens, let's see exactly what Washington was doing this week. Congressional Trading. Now to Capitol Hill, where the disclosure machine just coughed up a curious batch. The Senate standout, Arkansas Senator John Boozman filed 9 purchases, each between about $1,000 and $15,000, spread across Microsoft MSFT, United Health UNH, Oracle ORCL, Meta and Broadcom AVGO, among others. Here's the part that should raise eyebrows. Those trades date back to April of 2025. 16 months elapsed between execution and paperwork. The House moved faster this week. Tim Moore sold between $50,000 and $100,000 of AT&T, while David Taylor bought Procter & Gamble, PG, and Alphabet, GOOGL, and trimmed Microsoft. The week's cluster signal sits in House selling. David Taylor and Rich McCormick both sold Microsoft, and Richard Allen joined McCormick in selling Abbott Laboratories, ABT. Both clusters land on busy news. Microsoft has drawn attention for a reported $678 billion backlog, even as the stock wrestles rising long-term yields, and Abbott just agreed to a $670 million settlement of infant formula litigation. Meanwhile, the Senate's Boozman was buying Microsoft as House members headed for the exits, a split worth noticing. Zoom out 30 days and both chambers lean the same way, net sellers. The Senate booked 105 trades, 75 of them sales, with Apple AAPL, the most sold name at 8 sales from 2 members. The House ran 393 trades across 216 stocks, 208 of them sales, yet Alphabet was its most bought name, 7 purchases from 4 different members. So on the mega caps, senators are shedding Apple while the House keeps accumulating Alphabet. And a closing word from the Whale Watch, Congress files months late, but the options tape prints in real time. Same idea, follow the money. This month's board mixes triumph and humility. Someone nailed the 10x collapse with puts bought before the bad news. It's all up there on the board. A team call bet paid off too, while puts on circle and the gold miner fought the tape. The freshest whale money is spreading across chips and industrials, AMD, GE, Wells Fargo, not one crowded trade. The base rate keeps it honest. 413 qualifying tells this month, only 280 direction matched. Most big bets go nowhere. Insider activity. The clearest conviction story on the insider tape right now is Republic Services, ticker RSG. Over the past 2 weeks, 2 insiders there filed 31 separate purchases against just 2 sales, a cumulative $346.52 million of stock bought, with essentially nothing sold. That includes a single $160.5 million buy, the largest purchase of the week. Steady, repeated buying by executives is the strongest bullish signal insiders ever give. The broader mood is quiet, 68 insider purchases against 18 sales over 14 days, a buy-to-sell ratio of 0.5, but that tilt towards selling is routine. Taxes, diversification, options exercises. It's exactly why concentrated buying like Republic stands out. Outside the major indices, the dollars turned serious. Japan's Sumitomo Mitsui Financial Group poured $324.0 million into Jefferies, ticker JEF, one buyer, one position, the kind of size that suggests strategy, not a trade. And at BRVE, 3 insiders, Orbond Advisors, Biofund IV, and Erez Chimovitz, collectively committed $89.6 million. When several deep-pocketed holders of a small company buy at once, they're saying the market has it priced too cheap. That's the takeaway. Insiders see their order books, pipelines, and cash flows months before we do. When they put their own money down at this scale, that's about as strong an endorsement as this market hands you. Federal budget. Through August 20th, the Treasury's daily statement has the month running a $177.6 billion deficit, which, believe it or not, is the good news. That's $76.9 billion better than the same point last August, a sign revenue is holding up. But the composition is the real story. Social Security leads the monthly ledger, and right behind it, in a statistical dead heat with Health and Human Services, sits interest on the debt at $85.6 billion. Servicing old borrowing for a single month now costs more than double the Pentagon's $33.8 billion. File that away. It's the thread we pull for the rest of the segment. Receipts, briefly. $233.4 billion gross nets to $228.2 billion. August has no real refund season, so nearly every dollar collected counts. And on the 20th alone, another $5.2 billion in health insurance marketplace payments went out the door. Zoom out to the full fiscal year and the deficit is structural, not seasonal. Through August 20th, Washington has collected $5.5 trillion and spent $6.65 trillion, roughly $1.30 going out for every dollar coming in. The cumulative gap is about $1.6 trillion, a modest 3.6% better than last year, improvement at the margin. But the hole itself hasn't closed, and at this pace, the year lands near a $2.16 trillion deficit. Why? The decade view shows the post-COVID spending baseline ratcheted up and never ratcheted back down. And the bill for that baseline is interest. $1.15 trillion in 2024, $1.27 trillion last year, and this year's pace points to $1.4 trillion, roughly triple what it cost a decade ago. That's money that builds nothing and buys nothing. It just services the past. Which brings us to the debt itself. The headline number is $40.3 trillion as of August 20th, but totals like that don't register, so make it personal. Nearly $120,000 of federal debt for every American, north of $300,000 per household. The pace is what should stop you. It took until 2017 to accumulate the first $20 trillion. The most recent trillion, crossing $40 trillion on August 18th, took just 5.1 months. Every new milestone arrives faster than the last, and at roughly $96,000 of new debt per second, the projections put $50 trillion here by July 2029. Then anchor it against the economy. Debt to GDP is running about 123%, well past the 100% reference line, territory that historically signals fiscal stress. Not alarm, arithmetic. So who owns it? Mostly us, actually. Private domestic investors, pension funds, mutual funds, banks hold the largest slice at $27 trillion, about 2/3. Foreign holders account for $9.27 trillion, roughly 23%, a smaller share than the political rhetoric usually implies. The rest sits in government trust funds and at the Fed. Within the foreign camp, the shift is the story. Japan still leads at about $1.1 trillion. The UK has climbed to second at $939.9 billion, and China, steadily selling, has slipped to third at $633.4 billion. Meanwhile, the average rate on marketable debt has climbed from 2.96% in 2023 to 3.44% this summer. Doesn't sound like much, until you apply it to more than $31 trillion of marketable securities. That's how you get the $1.4 trillion interest bill from a moment ago, bigger than the entire defense budget. But here's the trap. $7.64 trillion of that marketable debt, nearly a quarter, reprices within 12 months, mostly bills and floating rate notes. Every 25 basis points adds $19.1 billion a year in interest. A full point adds $76.4 billion straight to the deficit, which adds to the debt, which means more interest next year. That's why this week's policy noise matters. Treasury is doubling long bond buybacks to suppress borrowing costs, even as Fed minutes show support building for a hike. The longer rates stay elevated, the more cheap legacy debt rolls into expensive new debt. It's an adjustable rate mortgage on a national scale, and the payment resets every year. Week ahead. Now let's turn the page and look at what's coming next week, because this is one of those weeks worth circling on the calendar. The headline without question is NVIDIA, ticker NVDA, reporting Wednesday, August 26. After a week filled with headlines about borrowing tens of billions to fund AI infrastructure, NVIDIA's results are the single biggest test of whether that build-out is still delivering. Salesforce, ticker CRM, reports the same day, the marquee name for enterprise software. And Wednesday is loaded beyond those two. CrowdStrike, ticker CRWD in cybersecurity, Synopsys, ticker SNPS, HP, ticker HPQ, Agilent, ticker A, Williams-Sonoma, ticker WSM, and J.M. Smucker, ticker SJM. Tuesday brings Intuit, ticker INTU, a useful read on household and small business software spending. Thursday is the consumer's turn on the mic. Dollar General, Dollar Tree, Best Buy, Ulta Beauty, and Hormel Foods will tell us how the tariff-squeezed shopper is actually holding up. And Marvell Technology, ticker MRVL, reports that same day, giving us a second read on AI chips barely a day after NVIDIA. Monday starts quietly with PDD Holdings. Then there's the economic calendar, and honestly, it might matter even more. The Federal Reserve's preferred inflation gauge, the core PCE price index for July, lands Wednesday alongside personal income, personal spending, and durable goods orders. Headline PCE has been running at 3.7% year over year, and the core reading is expected to tick up to 0.2% for the month. Given that this past week's Fed minutes showed support building for a rate hike, every decimal point in that report carries real weight for your bonds and your cash. Tuesday delivers consumer confidence, expected at 91.2, plus Case-Shiller home prices and new home sales. Wednesday also brings the weekly mortgage rate reading, which sat at 6.77% this past week. And Thursday, Chairman Kevin Warsh takes the stage at the Jackson Hole Symposium, with weekly jobless claims arriving the same day. Inflation Wednesday, the Fed chair Thursday. That's a dense burst of monetary policy signal packed into about 24 hours. So mark it down. NVIDIA, PCE, and Jackson Hole, all in one stretch. Whatever this market is going to decide about the next few months, it will likely decide it next week, and I'll be right here walking you through every number as it drops. That's your week ahead. As we near the end of the podcast, the key takeaways are: this week's real story wasn't stocks. It was trust in Washington's $40 trillion balance sheet, with money rotating out of dollars and long bonds into hard assets. One thing to watch: gold's crowd sits at the 91st percentile stretched, so a hawkish Warsh speech or a soft inflation print next week could unwind that trade fast. Every chart and number is at stockbeaver.com. Thanks for watching. I'll see you tomorrow.